Hey, welcome everybody to the 40 Finance channel. My name's Jeff Beers. Today we're going to be looking at some intriguing stocks, or popular stocks if you will, that according to Morningstar have no moat. Now a moat is a competitive advantage that is difficult, if not impossible, for competitors to take on a company. So if we think about brands like Coca-Cola, for example, they have their secret recipe, they have worldwide distribution, they got billions of dollars in marketing. It's very difficult to launch a similar type soda product and expect to take on Coca-Cola in any way. Now what's interesting about some of the stocks in this video is there's some of the hot and more popular names that you see people talking about, and they're newer companies that are still building their brand and their consumer base. But it's important to realize with some of these popular stocks, even though it's easy to kind of think about their mode or see how they may carve it out in the future, at least today in Morningstar's eyes, they still have work to do. Reminders always that my stock picks and projections are just my opinion for your entertainment. Please make sure you do your own research. However, if you do like stock market analysis and going deep on topics like this, please subscribe to the 40 Finance channel. Give this video a like. Thank you to everybody for your support. All right, the first stock today is BYND Meat, currently trading at about $144. Morningstar has a fair value price of $144, so at least after last close, it's trending just a little bit under that. And in terms of economic moats, let's see what they have to say. And I'll highlight this here. As the industry is in its infancy and most competitive products are in the early stages of expanding distribution, it is too early to know if BYND's first mover advantage will prove prohibitive to overcome, similar to wide moats like Coke or Pepsi, or if the new products, most of them from well-resourced firms, will be able to quickly develop products that resonate with customers. As such, we don't believe BYND Meat has carved out a sustainable brand and tangible asset at present, and given significant uncertainty, lack confidence that is poised to generate economic profits for more than 10 years, which underpins our no moat rating. So in that, they shared one of the keys to their definition of a moat, which is 10 years of profitable economic activity that they can keep competitors at bay. And at least in their opinion, BYND Meat has not shown the foundation for that, at least not yet. All right, one bonus that we'll do for each stock today is just look at TipRanks real quick to see what analysts think of a stock. And you have a few updates on BYND Meat. The most recent came 2 days ago. You've actually got some sells here that span all the way back to 2 months ago. Not a great sign out of the Wall Street analysts. You got hold, 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 sell, sell, sell. Interestingly enough, these prices are under Morningstar fair value. So I guess the crossroads here is, what do you think of BYND Meat? Do you think that they can carve out an economic moat over the next several years? And if you do, there could be an opportunity to buy low at some point this year. All right, next on the board is Aurora Cannabis. And this industry in general is one that I've been trying to wrap my head around as well, simply because, is it a commodity? Is it a retail product? It's really hard to try to figure that out. And at least in Morningstar's world, you got a fair value of 11. That is over the last close of 935. When we scroll down to the moat, we assign Aurora a no moat rating, although there appear to be a few potential sources of competitive advantages through intangible assets and cost advantage. We see several barriers that prevent Aurora from earning an economic moat, and they go on to talk about those. Cultivators and dispensaries require government licenses to operate in every market. As a result, companies with licenses could potentially be protected from outside competition, helping to establish pricing power. Next, they talk about the challenges to profit. Given that the cannabis industry remains in the growth stage, we think that years of significant investment will be necessary to support the robust growth in the industry. Going down, they talk a little bit about brand, potentially offsetting the challenge of generating economic profit from regulation. We think the creation of brand intangibles would help cannabis companies pass the increased cost to consumers, thus protecting their economic profit. And finally, we think that it would be unlikely for Aurora to establish a cost advantage. Due to climate, most cannabis in Canada is grown either in greenhouses or indoors. Although this allows for higher quality, these methods also cost much more, given the required lighting for climate control. Additionally, advantages in greenhouse and indoor can be much more easily imitated than geographic advantages that may be present in outdoor cultivation. All right, on the TipRanks side, last update came in 28 days ago. You've got a hold, a sell, hold. This is another one similar to Beyond Meat, really, where maybe analysts are starting to pick up on the concept that a moat for Aurora may not be in the cards. Next on the board is Teledoc Health. This one was interesting to me because, at the end of the day, you're talking about a Zoom call, right? To some extent with Teladoc, and you'd have to figure that there'll be a lot more competition for this type of industry. Perhaps in my opinion, Teladoc was just well positioned to take advantage of a unique situation with COVID. But let's see what Morningstar has to say. Scroll down, they give it a fair value of $210, which is, almost $50 above where the price sits today. So that's certainly intriguing. I think the big call out here for Teladoc is they actually see a potential moat, even though it doesn't exist today. This was updated on May 20th. After taking a fresh look at Teladoc, we are maintaining our no moat rating and adjusting our moat trend to stable from positive. Teladoc continues to be a leader in the nascent telehealth industry, and we anticipate a 30% compound annual growth rate for the company over the next 5 years. However, we see intensifying competition, record venture capital funding, peer consolidation, and even Amazon as barriers to entry are relatively low. While achieving a moat through scale on its own is difficult in an industry that can be described as commoditized, Teladoc can distinguish its offerings through its breadth of services. Following its Livongo and InTouch acquisitions in 2020, Teladoc has expanded its offering beyond virtual, ambulatory, and expert visits to include chronic care management and telehealth solutions for hospital systems. So I guess the way that I read that is Teladoc certainly has a chance to develop a moat, but it is important to note that competition is probably the biggest thing they have to fear. And that's sort of where my mind goes. In fact, I would argue that, why wouldn't Zoom get into this niche at some point? I'm not sure if they've explored that or not, but they've already got the video technology. Perhaps they just need to set up some different security systems to operate within the health space. I would say the biggest thing going for Zoom, if they did decide to jump in here, is the familiarity with the brand that most patients would already have. All right, over on the TipRanks side, we have most of our updates came in about 2 months ago during earnings season. 29 days ago was the freshest. You got a hold with a price target of 162. However, shortly after earnings, you had a lot of analysts coming in at the 200 level or above. So for a stock that's trading in the 160s, you certainly have a lot of votes in here that would suggest there's more room to run. All right, next on the board is Snapchat. Anything in social media, I think this makes sense, but Snapchat has been doing fairly well lately, so I thought it was important to include it. Fair value on this one at $68, which is just above the last close of $67.65. And scrolling down to the moat assessment, we assign Snap and no moat. While we believe the firm has displayed a network effect among its users and has begun to compile valuable data or intangible assets, we are not yet convinced that it will effectively monetize those users in order to generate excess return on capital for at least 10 years. So this is very similar to Beyond Meat, right? The firm is still in its early growth stage, and during its brief history, it has not generated excess returns, and we do not see any indications that it will do so soon. Further, the competition, which includes wide moat Facebook with nearly 2 billion users, is overwhelming in our view. The larger ecosystem of Snap's competitors may have also created somewhat of an exit barrier for their users, which we think will further limit the growth and acceleration of Snapchat users. All right, on the TipRanks side for Snapchat, relatively fresh updates within the last 30 days. You've got one hold at 70. Then you have several buys ranging from about $80 to $90 in here. Again, the fair value on Morningstar was 68. The price is about $67 today. So depending on which side you believe, there is still room to run for Snapchat. All right, next on the board is SoFi, which is a new fintech entry as far as consumer banking and loans and investing, all those things. This was a popular SPAC when it first came out. And looking down on the analysis tab, we've got a fair value of $20.50, which is right up to where the stock is trading at its last close. As far as analysis, this is the first report that Morningstar has done on SoFi. Looking down at the MOAT, it's relatively positive. In our view, SoFi has identified an unfilled product need in the marketplace that could potentially allow the company to build a defensible competitive advantage. The company targets young, high-income individuals that may be underserved by full-size banks. Company operates without physical locations and engages with its clients exclusively through its mobile app and website. Unlike existing digital banks, which generally have narrow product offerings, SoFi has built a broad offering of both lending and financial services that encourage its customers to structure the entirety of their finances around SoFi. On the negative side, however, while the company has made good progress towards these goals, it is simply too early to assume SoFi will be successful in building a competitive advantage. Currently, the majority of the company's revenue comes from its existing student loan debt refinance and personal loan business, neither of which have shown any signs of a moat. While we are encouraged by the momentum in the company's recent results, it has not made enough progress for us to have sufficient confidence that SoFi will be earning returns above its cost capital 10 years from now. Thus, we assign the company a no moat rating. So that analysis is obviously very similar to Teladoc, where they're saying, hey, there's some good things going on here, but in terms of economic moat, anytime over the next year or two, it would be hard to give them the benefit of the doubt until they start showing more progress. All right, on the TipRanks side, this one's a little limited because it is a new company and it is a SPAC. We got some coverage 10 days ago and 24 days ago, both of which were buys, both of which show fairly significant upside, plus 30% and plus 55% from today's price. Next on the board is Spotify, which is a premium, and I guess they also have for ad-supported music service. They're also becoming well known for the podcasts that they host and pay for on their platform. Taking a look at the broad analysis, fair value of 207. I think this is the first one today to come over fair value at 264. Let's see what they have to say about the moat here. And it's right up front. We believe Spotify can benefit from various network effects that will help the firm increase its users and amass valuable and tangible assets associated with user data and listening preferences. However, it faces intense competition and has a mostly variable cost structure that may limit Spotify's future operating leverage and profitability. Thus, we do not have sufficient confidence that it will generate excess returns on capital over the next 10 years. So you can tell how important that 10-year stretch is for Morningstar to get over any sort of hump on moat. You have to be a company that displays a competitive advantage that will allow you to continue to profit and build profits over a 10-year stretch. All right, over on the TipRanks side, we have a few updates here under 30 days or so. You got a hold, a buy, and then a few holds and a couple buys from about 2 months ago. Price target 275 is the latest. You also had a 375 about 3 weeks ago. I see a 280 in here. So one thing's for sure, the analysts that did come in and post prices, all of those prices are higher than the Morningstar fair value, and most of them are higher than where the stock stands today. All right, next up we have Snowflake. Fair value for Snowflake at 204, last close was 251. And Snowflake was a popular IPO here over the past year. It's basically an agnostic cloud data program, similar in some ways to Palantir in the sense that it can pull data from lots of disparate systems and bring them together. As far as the moats go, we assign Snowflake a no moat. We think Snowflake benefits from switching costs and a network effect, protected by its unique multi-cloud strategies throughout its data lake, data warehousing, and data sharing offerings. However, we cannot say with complete certainty that these moat sources will lead to excess returns on invested capital 10 years from now, given the limited public history of the recently public company, as well as its significant lack of profitability today. So once again, there's some potential positives in there for the future. However, today, considering it's not profitable and the expectation from Morningstar that you would develop the business over 10 years, at this point, they simply haven't ticked off enough boxes in Morningstar to achieve any sort of moat. All right, on the TipRanks side, got some fresh updates here over the past couple weeks. Got buy, hold, buy, hold. I would say mostly buys peppered in with some holds here. Price target 265, 265, 270. There's a 3, another 300, close to a 300. So the price is at 250 today. You've got most analysts projecting at least a 6% upside over the next 12 months. Morningstar, on the other hand, has fair value at 207. All right, so those are 7 stocks that, at least in the opinion of Morningstar, have not developed a moat yet. And as a long-term investor, you definitely want to investigate the moats of your stocks because it just offers another base layer of protection in terms of competition, etc. It's one reason, for example, why a company like Intel can actually survive almost the attacks, if you will, that they're getting from AMD and other competitors because Intel has certain technologies. They actually are a chip producer. It's one example of a company that may not be growing by leaps and bounds, but it does have this barrier that allows them to fend off the competition while they try to scramble and catch up to some of the new technology that's out there. All right, investors, let me know what you think about these no moat companies. Which ones do you think will eventually develop a moat over the next few years, and which ones may just evaporate over time? As always, if you like this video, please give it a like, subscribe to the 40 Finance channel. Thank you very much. We'll see you on the next video.